Welcome to the deep dive. Okay, so we've both been digging through this big stack of material you sent over on Samhi Hotels.
Yes, the Q2 and H1 results for fiscal 26, investor deck, the press release, the earnings call transcript, the full picture.
And it's pretty dense stuff, but what really jumps out, I think, is this sense that management is signaling something big, a real shift.
Absolutely. They're explicitly calling it an inflection point. Our job here, as always, isn't just to read out the numbers, right?
No, definitely not.
We need to pull out the strategy, the aha moments, especially how they've managed to shore up the balance sheet to kick off what they're terming transformational growth.
Yeah, it feels like they're moving past just fixing things and getting assets stable. Now it's about expansion, smart expansion, hopefully.
Disciplined expansion seems to be the message.
Okay, let's unpack this. Where should we start? Maybe the Q2 numbers, the baseline performance.
Sounds good. The operations are really the foundation for everything else. And focusing on same-store metrics gives us the clearest picture of momentum.
Right, apples to apples.
So Q2, year over year, rev payer, that's revenue per available room, it grew 11.2%, hit 5,026 rupees.
Solid growth.
Oh.
Above inflation, clearly.
Definitely. And total income kept pace, up 11.0% to about 2,963 million rupees.
Okay.
But here's what's interesting. The consolidated EBITDA, the profit measure, grew even faster, up 14.2%, reaching 1,105 million.
Hold on. Income up 11%, but EBITDA up over 14%. That smells like operational leverage, better cost control.
Exactly. That's the key operational insight. It shows strong flow-through, meaning a good chunk of that new revenue dropped straight to the profit line. It wasn't just filling empty rooms at any cost.
So they're getting better prices and running the hotels more efficiently. Is that sustainable, do you think?
Well, the result is a definite improvement in the EBITDA margin. It climbed 110 basis points to 37.3%. That suggests it's more than just a one-off. It shows better operating leverage now that demand is sort of normalized. And this performance, it lines up perfectly with their long-term guidance, aiming for 9 to 11% rev pair growth CAGR.
Okay, makes sense. But we have to talk about the huge number at the bottom, profit after tax, PE. The reports say it's up like almost 700%, 691%, hitting nearly a billion rupees. That can't all be operations.
No, not at all. And it's crucial context. That massive jump in PET is mostly non-operational. It's really about smart capital management and cleaning up the books.
Ah, the exceptional items.
Precisely. Two big ones drove that number. First, they reversed a previous land impairment for that Navi Mumbai property. That added back 696 million rupees.
Okay, that's a big chunk right there.
And second, they booked a gain of about 145 million from selling their Caspia Hotel in Delhi. Asset recycling.
Got it. So while the PET number looks amazing, the real operational story is that solid 11% revenue growth and the margin expansion. The PAT stuff is more about financial housekeeping and good portfolio management.
Exactly. Selling off an asset like Caspia, tidying up the accounting for the future flagship in Navi Mumbai, it shows discipline.
Okay, good clarification. Let's pivot then. From operations to the thing enabling all this future growth, the balance sheet. They keep hammering this point. Strongest financial position since listing.
And that's not just talk. It's the absolute foundation for this next phase. The deleveraging has been pretty successful.
What are the key metrics there?
Well, the main one is net debt to trailing 12 months EBITDA. Standard measure. That's down significantly to 2.9 times.
2.9x. That's already pretty healthy for a company looking to expand, isn't it?
It is, but then they provide another number, an adjusted one, that's even lower.
Yeah, I saw that. 2.4x. What's the adjustment?
And this is quite insightful, actually. The 2.4x figure removes the capital they've already set aside for these big new growth projects, the ones not generating EBITDA yet.
So they're basically saying, look, we've already earmarked the cash for future growth from our own operations. If you just look at the current earning assets.
Our leverage is actually super comfortable down at 2.4x. It's a strong signal that they're self-funding this expansion.
That's impressive. Does that tie into borrowing costs and ratings?
Absolutely. Their average interest cost has dropped to 8.5%. And Care Ratings noticed they upgraded them to A+ with a stable outlook.
Right. If we connect this to the bigger picture, that A+ rating, the low adjusted leverage, it's basically the green light for expansion, funded internally. How much firepower does this actually give them?
Management estimates they have an investable surplus, mainly from operating free cash flow, of about 1,700 crores.
Okay.
And their total committed capex for the current pipeline, including these two major new projects we'll discuss, is around 1,500 crores.
So they're essentially fully funded for everything they've announced. No need to tap markets excessively.
Pretty much. Funded by cash they've already generated or are highly confident of generating very soon. That's a strong position for an expansion cycle.
A very strong position. Which brings us to the really juicy part.
Yeah.
What are they building with all this financial strength? Here's where it gets really interesting. Let's dive into Navi Mumbai first. That seems like the biggest strategic bet.
It really is. It's huge strategically because it finally plugs the gap in their footprint. They're entering the Mumbai metropolitan region, the MMR. Now they'll be in all 5 of India's largest office markets.
Delhi, NCR, Bangalore, Hyderabad, Pune, and now Mumbai completes the set.
Exactly. And this isn't some small boutique hotel. This is set to be their largest property by room count.
What's the plan?
A massive dual-branded hotel. They're proposing a Westin and a Fairfield by Marriott on the same site. Phase 1 alone is targeting about 400 rooms.
Wow.
With the potential to eventually scale the whole complex up to maybe 700 rooms?
Location, location, location. Why Navi Mumbai specifically? It feels like a bet on future growth, not current density.
That's the core insight, I think. It taps into that structural shift we see in big Indian cities, the economic center of gravity moving away from the old CBD. This is the aha moment.
A city center to new center play.
Precisely. The site is near the upcoming Navi Mumbai International Airport, the big D.Y. Patil Stadium, and crucial new infrastructure like the Atal Setu Trans Harbor Link.
So they're planting their flag where they expect future demand to explode, mirroring what they did successfully in, say, Bangalore's Outer Ring Road or the Hyderabad Financial District.
Exactly. Betting on the infrastructure development and the corporate migration that follows.
But these big infra projects can face delays. Isn't that a risk? How are they managing that?
That's where the capital structure really helps. Remember how we mentioned that land impairment reversal?
Yeah.
Well, the backstory is that they acquired this land parcel years ago, almost like a side benefit, a gift, as they put it, through an earlier unrelated acquisition.
So the underlying land cost is extremely low.
Cheap, essentially. Which means their estimated cost per key for building Phase I, around 1.65 to 1.7 crores, is significantly below what it would cost to build something similar from scratch in the Mumbai market today. Way below replacement cost.
Okay. So the low entry cost gives them a buffer. If the area takes a bit longer to develop, their returns aren't immediately destroyed. It buys them patience.
It totally de-risks the project timing to a large extent. Protects the ultimate return on capital employed, the ROCE.
Makes sense. So Navi Mumbai, huge scale, flagship potential, owned asset, low land cost, betting on future growth. But then there's the second big project in Hyderabad, which sounds completely different.
Yes, and it's a great contrast. It really highlights their flexibility and focus on capital efficiency.
What's the deal there?
This one is a 260-room mid-scale hotel planned for the Hyderabad Financial District. That's a market they know extremely well. It'll be their 3rd hotel just in that specific area.
Okay, proven market. But how is the structure different?
It's being done via a long-term variable lease. This is key. The developer builds the main structure, the building shell, and provides the major services infrastructure.
So Samhi doesn't have to outlay cash for the core building.
Exactly. Samhi's investment is primarily just for the interior fit-outs, and the estimate for that is incredibly low, only about 45 to 50 lakhs per key.
Wow, that is capital light.
Very. It drastically cuts the upfront capital needed and, importantly, shortens the time between spending the money and actually generating revenue. The capex to revenue cycle is much faster.
So 2 very different approaches. Strategic ownership in Mumbai, where land was cheap, and a super capital efficient lease model in a known hot market like Hyderabad. That feels sophisticated, mature.
It shows they aren't dogmatic. They'll use the structure that makes the most sense for the specific opportunity. And looking beyond these two, the overall pipeline is quite active.
How big is the total pipeline now?
They have over 1,500 rooms currently under active development or being rebranded. That pushes the total portfolio size towards over 1,300 rooms once completed.
Any other major projects moving along?
Yeah, the W Hotel in Hitech City, Hyderabad, that's about 170 rooms, is progressing. They're targeting a late 2026 opening for that one. Plus ongoing conversions like the Westin Bengaluru work and some tribute portfolio rebrandings.
And all this expansion, especially the Navi Mumbai project, is clearly designed to shift their overall market positioning, right? Moving up the chain.
Definitely. It's a deliberate strategy to increase the revenue coming from the upper upscale and upscale segments.
What's the target mix?
Right now, those top segments contribute about maybe 42% of revenue. The goal is to push that up to around 60% once all these committed projects are up and running.
That's a significant shift. Should improve overall ADRs and margins, presumably?
That's the plan. It dramatically lifts the average quality and the earning potential of the whole portfolio.
Which loops back nicely to the dual-branded strategy like we see in Navi Mumbai with Westin and Fairfield.
Yeah.
Why is that structure so effective for ROCE compared to just building one big Westin?
It's all about managing yield and segmenting different types of demand effectively.
Yeah.
They've already proven this works well with their Courtyard Fairfield combo in Bangalore.
How does it work in practice?
Well, you take the base business, the larger corporate contracts, maybe some lower-rated group bookings, things that provide volume but at a discount, and you channel that into the mid-scale brand, the Fairfield in this case.
Okay, so Fairfield handles the volume. What does that do for the Westin?
It frees up the Westin, the premium brand, to focus exclusively on higher-rated business. Think IME scenes, incentives, conferences, exhibitions, and high-end individual travelers, people willing to pay the full Westin rate.
So you don't end up diluting the expensive brand's pricing just to fill rooms.
Exactly. You protect the Westin's ADR potential. By splitting the demand, you maximize the revenue and, ultimately, the ROCE across the entire combined property. It's smarter segmentation.
Very clever. It really reinforces their core strategy, doesn't it?
Yeah.
Stay disciplined, focus on those top tier 1 office markets where demand is structural.
Right. And secure assets either through smart M&A, like how they got the Navi Mumbai land effectively, or through these capital-light variable leases. They're generally avoiding risky greenfield land buys.
Navi Mumbai being the exception that proves the rule because the land risk was already minimized.
Precisely. So the takeaway from all this material is pretty clear, I think. The operational engine is humming, the balance sheet is strong and self-funding, and now it's all about executing on this significant, well-structured pipeline.
Yeah, they seem fully shifted into build mode now. So, summing up this deep dive, Samhi's Q2 results confirm strong operational performance. But the real story is the strategic pivot enabled by that strength.
Right. Robust growth meets executable, capital-efficient expansion plans. The Navi Mumbai ownership play and the Hyderabad lease model show flexibility.
Both designed to build scale and drive higher margin revenues over the coming decade. The foundation's there, the money's allocated, the strategy's clear.
Now it's just about delivery. Execution is everything from here.
Okay, and as you think about Samhi decisively planting flags in these future growth corridors of India's megacities, here's a final thought to chew on. If this city center to new center trend keeps playing out, and Samhi seems very good at betting on it, just how much bigger could the market share become for hotels located in these new economic hubs? Think about when places like Navi Mumbai or Hyderabad Financial District potentially surpass the old CBDs in sheer scale and demand.
Yeah.
That's the long-term multi-decade prize they seem to be positioning for.